What's up guys? In this video, we will be going over how to sell a put on Robinhood, which is my personal favorite strategy because I think it's the easiest way to aggressively grow your portfolio while being as safe as possible. I know a few other tutorials already exist out there, so hopefully you learn some new tips that I go over in this one. So step one is to find a stock that you want to buy. That way, no matter the result of the put, you're a winner either way. Since I just sold puts on Spirit Airlines about a week ago, for today's example, that's the stock we'll be looking at. If you don't already have options enabled, you'll have to go in your settings on Robinhood, answer some questions, and then you can start trading. So let's go to trade options. At the top, you see all the dates. To get started, you have to select on one of those dates. Once you do that, you can see the buy and sell option on the top left portion of the screen. You can see the call and put option on the top right portion of the screen. Today, we're going to be selling a put, so our options selected are sell and put. So the reason I'm choosing Spirit Airlines is because I want to own the shares. I think they're currently undervalued right now. I would be happy to be a shareholder. At the same time, if I'm collecting the premium from just selling the put and I don't own the shares, it's not the end of the world because I can just sell the put again next week. To first sell a put on any stock, you need to have the capital to afford at least 100 shares of the stock. In this case, Spirit Airlines is a pretty cheap stock at just $4 a share. So that means I only need $400 to sell a put. You can see the details here. The $4 put, it says 12 cents on the right. Your break even is $3.88. Chance of profit, the current share price, April 19th on the top left. What does this all mean? So the first thing I look at when selling a put is the expiration date. Today is April 13th, which is a weekend, so the stock market isn't open. This is the closest date of expiration we can choose on a weekly basis. Most high volume stocks have an expiration date every single Friday, which is the end of the trading week. I personally like to do the end of the Friday as close as possible. You can play around and do different dates. You can see here, off of the $4 put, if you're putting in $400, you're getting paid 12 cents per share you put in. Everything you're seeing here, you need to multiply by 100. So, as an example, let's sell one, you actually get $12. There is a 3-cent fee per option Robinhood charges, and that's a flat fee on any stock. So if you're doing a higher valued stock, then that 3-cent fee is going to be a much tinier percentage than it is here in this case. But why sell a put over just buy the stock itself? That is an extremely easy answer. You can think of it as you are getting paid to place a bid on these shares lower than current market value. The shares are at $4.17 right now. So if you wanted to own the stock today, you would have to spend $4.17 per share. So why would you not get paid $12 to place a bid on Spirit Airlines at $4 a share? A contract like this really is too good to be true. I like to think of it as you are selling insurance to someone, or you are the house as if you are the casino selling a bet to someone. Whoever is buying this option off of you is placing a bet that Spirit Airlines is going to go down, or they're a very large shareholder and they want to protect their investment. If Spirit Airlines absolutely tanks, they're still able to unload their shares off to you at $4 a share. So let's recap that. If I wanted to buy 100 shares of Spirit Airlines stock today, I would need to spend $417 because that's what Spirit Airlines is at today. We can go to trade just to buy the stock in terms of shares. enter 100, and there you see the estimated cost of $417. So I suppose that would be the one downside of the strategy, that you need to have the capital to afford 100 shares, because if you don't, you can't do the strategy. It's as simple as that. Anyways, going back to the option, it just doesn't make sense to me why anyone would buy stock of a company when you can sell a put to own that stock at a lower price, or you collect that $12 and you can do it again. So how a put works is you only get assigned the shares if the share price falls below your strike price, which in this case is $4, before the expiration date of April 19th. Technically, if the stock falls below $4 before April 19th, whoever purchased this contract from you can execute and turn your money into shares, meaning they take your money, sell you the shares of Spirit Airlines at $4 per share, but that's pretty rare. In my experience, that doesn't really happen until after the market closes on your expiration date. So let's play around with expiration dates just so you get an idea of what changes. Another reason I love this strategy so much is time is always on your side. While a stock is bouncing and you're not selling, or it's just staying flat, you're collecting money because this premium decreases in value as time moves closer to the expiration date. For example, if it was April 18th and the stock was at $4.17, you would not be able to get 12 pennies per share or $12 per contract. You would be lucky to be able to get $1 per contract, because that bet that Spirit Airlines is going to be under $4 a share in just one more trading day is super unlikely. So now that insurance premium you just sold to someone, or that bet that you just sold to someone, the odds of that happening and coming true for them, it's not as likely, whereas now they have a whole week of stock movement action. So let's take a look at April 26th. You can see that the $4 put, it's almost double the value as this Friday. So that's actually pretty good. That's better than what I typically see. Let's keep moving on. May 3rd, you can see it moved to 29 cents. May 10th, 37 cents. May 17th, 41 cents. So you can sell a put as far out as you'd like. We can scroll all the way to the max available, June 18th, 2026, $2.57 on that $4 put. Now that's absolutely ridiculous. If you're willing to lock your money in for that long, you're getting paid well over 50% on the money you're putting in today. The reason I never do that is predicting a stock price movement that far out in the future is really difficult, and you typically maximize your gains by selling a new put contract every single week. For example, if you get 12 cents here, or $12 per contract, that's 3% in relation to how much money you have to put in. Because when you put in $400, obviously $12 payment on that is 3%. Whereas the next week, it's just under 6% at 23 cents. And it only continues to go down because the amount you see here, it is a safer bet for you as the seller with time. You can see your break-even price is decreasing every expiration date as we move out further. So it's a safer bet for you in that way, that the stock has to drop more for you to start losing money and be negative on your sold put. So it's really up to you with your risk tolerance, but I personally have the most success setting the expiration to the closest Friday as possible and rinse and repeat. So let's get to the outcomes of selling a put. What can happen? We already talked about when the stock dips below $4, how you can get assigned the shares, but when are you losing money? Well, that's your break even. Let's say Spirit Airlines goes to $3.99 a share and you get assigned on your put contract. You are not down in this case. You are actually still up $11 because of the premium you were paid. The break even is super clear, so you have to keep that in mind. You're not actually losing money until the stock falls below your break even price. The other result is your money gets returned to you and the option expires worthless. This happens when Spirit Airlines closes on your expiration date above the strike price. So if Spirit Airlines closes at $4.01 or higher, your money is returned to you. That $400 you locked in to originally get paid that $12 upfront payment, that's returned to you. Your new account balance would be $412. So typically that result is the one I am looking for, because then I can do the strategy the very next week and have that 3% cushion in my pocket. So let's say a week goes by, I lock in another $400 into Spirit Airlines. I get paid an additional $12 if in theory it's at this same market value price. Then while my $400 is locked in, I have $24 in my account, and that will continue to grow week after week. As for the chance of profit percentage that you see, I really ignore that. That number just fluctuates so much every day. I do not think that is important to pay attention to, in my opinion. When selling a put, where the stock price is at is moderately important, because at $4.17, you can see the market rate is 12 cents per share, or 3% to sell the contract. But if you wait, let's say market opens on Monday and Spirit Airlines falls to $4 a share, this put is going to be much more expensive. It would likely go maybe 20 cents. You would get $20 or 5% on your investment, because now for the buyer, it is a much safer bet that the stock is going to fall below the strike price versus today at $4.17. So this is super important, because you have to think of put options of how much cushion you have to your strike price. Because in this case, not only are you getting paid 3% to sell this put, you also have a cushion from $4.17 to $4. That's your max profit cushion, because anything above $4, you're making the entire $12 premium. Airlines in general are known to be less volatile stocks. Spirit Airlines recently, of course, isn't, if you are into looking at their charts. But right now, Spirit Airlines has to fall just over 4% just to hit the strike price of $4, and then it has to drop an additional 3% to hit your break-even price. To me, that is absolutely mind-blowing, that a stock has to drop 7% just for you to even start to lose money. And wrapping back to why the strategy is undefeated, it's because if you wanted to buy the shares anyways today at $4.17, if the stock drops, you only would have lost more than selling this put. So that brings us to our second downside. Our second downside is if the stock takes off and pumps today, right now, when you sold this put, the most you're gonna make is 3%, and you miss out on the rest of those gains. But even in this last bull market for the last year plus, selling puts throughout everything pumping has made me more money than if I held a stock and it just went along with that pump. Because think about it, if you average 3% a week, which is pretty realistic, that's 12% per month, beating the S&P 500 its yearly return in just 1 month. So let's go to actually selling the put. Selling one, we kind of already looked at this process earlier. You would just hit review. You can see your max loss on the bottom of $388. That's because you're getting paid $12 up front. And that max loss is if Spirit Airlines goes to zero in 1 week, which in theory is possible, but realistically that would never happen. If there's no big anticipated news coming up like earnings, the most you're ever gonna lose on this strategy, again, realistically, I would say is about 20%, and the odds of a stock taking that much in a week are already so low. That is why this strategy is the safest for how much money you can make. So let's hit review. You can see the order summary at the bottom, which is super helpful and breaks it down as well. You can read that. You're going to buy 100 shares at $4 a share on or before April 19th. If you aren't asked to buy save by then, which means Spirit Airlines is above $4 per share, then you'll keep the full collateral credit of $12 plus your refund of $400. So let's hit submit. I know it's not going to go through because it's on the weekend, so you can see the order will be executed right at open. So we have this order in the queue here. I'm going to go ahead and cancel just because this is an example. So now I want to take you through my actual trade of selling a put on Spirit Airlines about a week and a half ago and all the different outcomes I could have done with it, so you know what to do when you sell your first put. So at the time, Spirit Airlines was at $4.61. It's a down day. I love selling puts on down days because that premium is going to be higher than if you have a green day. When there's a red day, I think it's a higher chance that a stock is going to bounce up. Overall, I just feel safer selling a put. You do not want to sell a put when stocks are at highs, because that is when the strategy does not work and you get burned. If something has been climbing for months and months and months, a lot of time a stock will have a very aggressive drop and decline, and that is when you can lose 10-20% in a week. So while you may have success selling puts on a stock that is climbing over a year, you're going to be winning that whole year. But just expect that a big loss can happen. And hey, the purchaser of your contract, they have to win sometimes too. So if you're not making money every single week on this strategy, don't get discouraged. Of course, there's a huge fluctuations with what stocks you're doing it on and how volatile the stocks are. Anyways, going into this example, thinking of my thought process, Spirit Airlines is hitting a huge low in their history of existing. I think this is a good time to sell a put. At the time, since Spirit Airlines was over $4.50, I sold the $4.50 put. I got paid $11 per contract I sold. I sold 46 of those contracts, so the total came out to be just over $500. You can see the break even there of $439. So I had about a 2.5% cushion to the strike price, and I got paid an additional 2.5% premium to sell the put. I did this on a Tuesday or Wednesday, so it wasn't the full week. So it was even less risky for me because there were less days that the stock price could move and go below that 450 number. So the put went through. You can see here the max I can make from the premium is $506. I had to put in $20,700 to get this return. Another reason I really like this strategy is you can use the premium you were paid and sell another put, at least if you're using margin, which is the default on Robinhood, which all that means is the money doesn't have to settle in your account. You don't have to wait 2 to 3 days to use that $500. You can immediately put it into something. So I sold an additional put here with that money to get an additional $11. So even though it says $20,700, the money I put in here from my own was about $400 to $500 less than that. So here are the details. I sold it on April 2nd with expiration April 5th. I actually sold this at the end of the day. I like to sell my puts as close to the end of the trading day as possible because the most premium decay happens with time and over the next day. So what that means is if the stock opens on April 3rd at the same price it is today, I'm gonna be up a few dollars per contract because there was no overnight movement in the price. Boom, advantage of selling a put helping you, whereas if you were owning stock and this happened to you, you wouldn't make anything and you would just be sitting there in a neutral position. What's even better is if the stock goes down, let's say a couple pennies, I might still be up because the stock didn't go down enough for the put buyer to be winning or be closer to that strike price. With that being said, you win on a daily basis as the put seller if the stock doesn't go aggressively down. So if it goes down a little bit or stays the same or goes up, you're winning in every scenario, and it is such a good feeling to be winning a majority of the time. So here's some more numbers for you. What's really important is the last trade, previous close, low, high. I think it's important to track how the option is moving That way you can relate to what the stock price was and how much money you can get for selling that option. If the last trade was at 10 pennies per share, I know the trade I made selling it at 11 pennies per share is a pretty good deal above the last trade. All right. Volume is pretty important too. If there's no volume in a contract, it may be difficult to purchase or sell a contract. Typically though, if there's an expiration date every Friday, like we talked about earlier, then you're not going to have the issue with volume. Personally, IV, you see here the 95.17%. That means implied volatility. I honestly ignore that. I'm not too concerned with that number. It's just the expected movement of the option price or the stock price for this week. I don't see it making a difference for me. The Greeks below, that's just a little bit more detail of how the price of the option is going to change. I ignore all those numbers as well. You can look into that if you want to, but to me, it just doesn't seem important. All right, let's fast forward to one day before expiration, April 4th. You can see that the option now, it is close to worthless at 2 pennies per share or $2 per contract. Anytime you see the contract price, that's always the ask or the mid between the bid and the ask. So the stock price did go up, as you can see, to $4.83, which is why the contract is close to worthless. When I say worthless, that just means 1 penny or $1 per contract. At this point, I'm feeling good. It sounds like I have that 2.5% premium in the bag. I actually did try to place an order to buy back my 46 contracts at $1 per contract. And you may ask why? Why did I do that when that $46 is guaranteed and all I have to do is wait 1 extra day? That is because I'm trying to maximize my return at all possible times. So I could free up that collateral I put in of over 20,000, put it in a different stock that's gonna have a higher return, or a stock that is closer to a strike price, because at $4.83, it's kind of floating in between the $4.50 put and the $5 put. It's difficult to make money on that unless I sell a put out for the next week, because buying this back at $1 per contract, that is only a fourth of 1%, whereas I could move my money and then get paid closer to 1% for a different stock. Anyways, that's a little bit more advanced and you don't have to worry about that if you're selling your first put. So let's see what happens on the day of expiration. So this is actually Monday. What happened Friday was Spirit Airlines did end up tanking pretty significantly. It ended up closing the day at $4.43. As you can see here, it was up 23 cents first thing Monday morning. So my money turned into shares. However, I wasn't worried because no matter the outcome of this option, I wanted the shares anyways. So that means that order I put in to sell my 46 contracts, or technically buy them back at $1 per contract, it didn't end up going through at the time, unfortunate, since it ended up going down the next day. But even at $4.43 a share, I was still profitable on that trade, since my break even was $4.39 a share. So at that point, at the close of Friday, if I wanted to, I could have bought back my options, not let my money turn into shares, and still profited 1%, which is what I do a majority of the time. That way I can put my money into something else for the following week, use that weekend of time to decay the option if the stock ends up opening flat on market open Monday. But that's not what happened here. The outcome here was the stock went below my strike price of $4.50. All of those puts that I sold turned into shares. I got super lucky that there was a first thing Monday morning pump, but honestly, looking at the chart for the history, Spirit Airlines had been bouncing. So something like this wasn't super unexpected, but this is absolute best case scenario. If your stock goes below the strike price, your money turns into shares, but you're still profitable from the break even to the price of the options turning to stock. That way you're not sweating it, you're up on the trade, and you have the option to make as much money as possible before selling the shares. As you can see here, I immediately was up 5% from where I was Friday at close. This is a textbook trade. I did sell immediately at market open when I woke up. So not only did I get paid about 2.5% to sell the puts, I made another 3.6%, as you can see there on the stock, for a total of over 6% in just 4 trading days. So just like that, boom, my investment of $20,200 turned into about $21,450. And now I can use this money, reload it into a new put, rinse and repeat this process and the strategy, and continue to aggressively grow my portfolio while limiting my downside risk. So I hope that helped. I tried to make this tutorial a little bit more technical because there's a lot of really basic and simple ones that already exist out there. So if you watch those, hopefully you learned something here. But what I would recommend is to start out with a small amount of money. If you are interested in learning how to implement the strategy, just go find any stock for $1, because then you can sell a put using only $100. Worst case scenario, that put goes to zero within the time you sell the put to the expiration date and you're out your $100. But what you learn and what you see of the price movement of the options and how the stock correlates to the option price, I think is really important to have that knowledge. And secondly, you can play around with letting your money turn into shares. If the stock price dips, you can practice buying back your option and then putting your money into a new put. I do this strategy almost every single week, sometimes multiple trades a week, and I have a lot of success, and I know you can have a lot of success too. Let's go, guys.